Is no change in the Central Bank of Canada rate really breaking news? Normally I'd say no, but in this crazy economy, with all the noise out there in the media, it really helps to get every last bit of good information that we can get to help us move forward and understand what's really happening. I'm Brent Richardson, mortgage broker and certified financial planner, and in today's video, we're going to look at why the Central Bank of Canada was confident in leaving rates where they're at right now, and we're also going to look at, most importantly, how is this going to affect you? How is this going to affect the housing market and the mortgage market, the interest rate market going forward? And so let's jump right in. Currently, the Central Bank of Canada rate is at 4.5%, and the commercial bank prime rate is at 6.7%. The commercial bank prime is where you get variable rate discounts, for example. It's what consumers get, and the bank basically pays the central bank rate. And so the central bank was confident to leave those rates as is right now, mainly for the reason that in their eyes, inflation is on track to get down to their 2% target in about a year and a half. Sometime in 2024, they expect it to get there. And so they don't want to increase rates more than they need to do that. They need to cause some economic slowdown, but they don't want to break the system either. There's been a lot of speculation of if these increases would do that, if they would break the system, but it still seems like there's some strength out there. For example, we had 150,000 new jobs in January. That's a big economic strength, and it was really unexpected. We've seen an increase in retail sales over the last couple months, which was a little bit, it was a bit more expected, but it was a strength nonetheless. We've seen a bit of a pickup in housing as well. We've seen a bit more bidding, some over asking happening. And so we're seeing these strengths out there, but at the same time, and these strengths are not good for inflation, by the way. A strength is normally, I mean, bring it on, the more the better, but when you're trying to get inflation down, those aren't the greatest things to see. With that said, inflation, the data is showing that it is dropping, and that it went from, I believe, 6.3% down to 5.9% on the inflation number. So it is dropping. And also, the gross domestic product, this is Canada's productivity, this is a measure of our country's economic growth, that's pretty much flat. And so, Canada isn't really growing. The growth has slowed, and really it's probably negative growth, but the GDP numbers are saying that, it's flat. And so the central bank is looking at those big numbers, and they're saying, yeah, there's some mixed data out there, but that we see the main numbers trending down. And what really makes them confident that these numbers will continue to trend down is that it takes time for the rate increases that they started last year. March 2022 was the first Central Bank of Canada increase in this cycle. That has been a year, and it takes a year for that to click in, to really have full effect. And so throughout 2022, there were several more increases. I think pretty much all throughout the year, we had 1% increases and 0.75 increases, and there were 4.25% worth of increases in 2022. And as 2023 moves on, and those kind of 1-year anniversary dates from previous year's increases happen, we're going to continue to see a momentum of economic slowdown, and this should have an effect to reduce inflation. So right now the central bank is saying we're confident enough that we're on track to see the economy slow and to see inflation move down with it. And so that's what really we're monitoring to see how this momentum of economic slowdown builds. Now, how is this going to affect the housing market? As this plays out as planned, how is this going to affect the housing market? Well, the housing market has gotten a little more volatile. There was some sense earlier this year that, hey, there might be an interest rate drop mid 2023. That didn't really pan out. They pushed it off to the beginning of 2024 for the first drop. Nevertheless, the housing market, on the news of an interest rate pause with some lower fixed rates due to lower bond yields, it actually nudged up a bit. With that said, we're not likely to see a sustainable increase in the housing market at this point. In my personal opinion, I don't think we can. If there was a 10% pop in housing prices and if it was any kind of a sustained rally, the central bank, this would just be one main trigger to keep increasing rates. That would be hugely inflationary, and it would have the central bank saying, well, I guess we didn't increase enough. And so what we're probably going to see is the housing market kind of trend sideways, maybe a bit down over the next few months into the summer. The spring housing market might be kind of a slower market. There are really two forces affecting the housing market right now. There's supply and demand on one side, and really it comes down to a limited supply. There's not a lot of listings. There's not a lot of options available to buyers, and buyers are really a lot of them on the sidelines looking to get into the market. The market's just rearing to go. It's chomping at the bit. However you want to put it, this market is pretty much ready to go. But the options just aren't there, and there's still some question about, is this the time to buy? And so that is basically having an upward pressure on the market, less inventory and lots of demand is pushing the market up. What's pushing it down, of course, is rates. And so, I think that the rates will win this battle as long as it needs to or wants to. The rates will remain high and possibly go higher if the housing market takes off prematurely. Again, that's an important message here if we're looking at, when to get in. Well, I think any time pretty much is a good time to buy a house. If you're going to live in it, go out 2 or 3 or 4 years, you're probably going to be more than okay. If we're looking for an exact bottom, it's probably going to be in the summer, maybe autumn of 2023. And that really aligns when mortgage rates might start to come down, the fixed rates. If inflation stays on track, the central bank is actually expecting inflation to hit closer to 3% by the summer. Again, in my opinion, that seems like a very aggressive number. That is a lot of kind of drops in inflation that need to happen to get there, but they seem confident in it in today's comments. And so if we do see the inflation dropping closer to 3%, over the next few months, over the next 3-4 months or 5 months, then we're likely to see fixed rates drop. We're likely to see the housing market start to have more of a sustainable rebound. As far as how low rates are going to go and how long is that going to take, the central bank has a neutral rate of 2.5%. So the neutral rate is, right now they're at 4.5. The neutral rate is 2.5, which in their opinion does not stimulate nor does it suppress the economy. And so essentially that's their target rate as well. And over the next 2 years or so, or 2.5 years, they expect to get to that neutral rate by the closer to the end of 2024. They expect inflation to be closer to 2% by the end of 2024, and they expect to be closer to their neutral rate then as well. So that's 2%. Even if their neutral rate turns out to be closer to 3%, that still represents a 1.5% decrease, which is a pretty substantial increase or decrease from where rates are at right now. So we can expect to see mortgage rates in the mid to high 3% range. Mid to probably closer towards the end of this year, mid this year, they'll probably start to fall. They'll have another shot at dropping as long as inflation continues to cool. By the end of the year, we may break that 4% into the 3, and then fixed rates going into 2024, well into the 3% range, and we'll also start to see, if it goes according to plan, the central bank's plan, a decrease in early 2024 as well on the central bank rate throughout 2024. And so that's housing. Probably will stay pretty flat for the next few months towards the mid to end of 2024. It's going to likely gain some traction, some sustainable traction. Rates tell a similar story. Probably fairly consistent over the next 2-3 months. I wouldn't expect any major drop, but even if we get closer to what the central bank is seeing as far as inflation dropping, we should see rates start to go down too. And at the end of the day, it's not a matter of if, in my opinion, it's a matter of when. And so it looks like there's still a light at the end of the tunnel, although we just need a bit more data to show the consistency of what's happening. And given the fact that rates take a long time, a year plus, to really kick in, we haven't given it a fair chance yet, but the next few months will be very telling. I look forward to monitoring that with you. Please leave comments below. What are you thinking? What are you seeing? That's just as valuable here. Come join the conversation. Thank you so much for watching. I look forward to chatting soon. Thank you.